Nary a corner of the globe went untouched in the years following the financial collapse, which started 5 years ago this month. Joining us now for an update on the global recovery efforts. In London, UK, Martin Wolf, Chief Economics Commentator with the Financial Times of London. And Mr. Wolf, we're very grateful to have you back on the program. How are things on the other side of the pond?
Well, I'm very pleased to be back. In fact, I'm visiting Canada very soon. And over here, it's very autumnal, but I imagine it's beginning to be like that over there too.
It is indeed. And when you come to town, you'll please let us know, because we'd love to have you on again in the studio, as we did not too long ago. Tell me now, with the benefit of 5 years of hindsight, how significant was the Lehman Brothers collapse in terms of creating the Great Recession?
I think it was the trigger. And triggers are always important because bombs don't go off without them. But we did have a bomb. And I have the bomb was the amount of debt we'd accumulated, the amount of fragility we'd created in our financial system. And I also think that if it hadn't been Lehman, something else would have set it off. If we think back to those times, there were so many points of fragility in the system that something was bound to happen.
And again, given the benefit of 5 years of hindsight, was it a good idea to spend the billions and billions of taxpayers' dollars bailing out these big banks?
Yes, I think it was pretty well inescapable. We had at that stage no way of resolving the banks, as it were, of putting them through some sort of process that would maintain them in existence. And we saw that very clearly with Lehman. When it was allowed to go, it was a complete meltdown. If you imagine a world in which quite suddenly most of the world's major banks disappear, well, I think it's not terribly difficult to conceive of what that would then look like. I think it would be have been worse than the Great Depression. GDP, the economies would have essentially collapsed. So given they had no other tools then available, is a question whether they now have them, big question, but they didn't have any other tools. They could let possibly a bank go under, but let what would then have been, I think, a whole skittle row of banks go down. I think it would have been impossible.
Well, you've put your finger on something I want to follow up on now, which is, in the 5 years since all of that, has in fact the financial architecture of our financial system around the world been satisfactorily changed to prevent this kind of thing from happening again?
I think the answer is yes and no. The yes is it's been changed quite a bit. It's more resilient than it was, and they've got more tools than they did before. But I think it would be extraordinarily rash and definitely wrong to argue that such a thing couldn't happen again. I think we've somewhat reduced the likelihood, but it could still happen, and probably will.
Well, let's unpack that a bit. What has happened in the last 5 years that encourages you to think, yes, that was a good thing, that will lessen the chances of this happening again?
I think the most important things are that banks do have more capital, so they have more loss-bearing capacity. That's particularly true, I think, in the United States. Their liquidity requirements are stronger. There's been some improvements in market structure, not, I think, anything like as much as we need, but there's certainly been improvements in that respect. We have resolution regimes which will probably cope with most fairly simple banking institutions. So these are moves, as it were, in the right direction. And regulators and supervisors are unquestionably, for the moment, much more hawkish. They're much less likely to take it on trust that the banks know what they're doing. So these are moves, I think, probably in the right direction. But the system remains fundamentally highly interconnected and very fragile. And with very large institutions which are themselves fragile and interconnected, in this situation, you just cannot rule out the possibility that events will occur that will lead to another chain of bankruptcies and another series of worries. And we really don't have satisfactory tools for dealing with the system as a whole in that condition.
So if you could wave the proverbial magic wand over this and do something that so far the decision makers haven't done in order to create a more secure financial architecture, what's missing?
Well, my feeling is that the single most important thing there are lots of other things, and this is very controversial, but the single most important thing is much more capital. That is to say, much more loss-bearing capacity, which means that creditors can be confident that even if an institution were wound up, they will be secure, they will be protected, which they couldn't be before now. Now, just to put this in context, there's a big discussion at the moment of how much equity capital loss-bearing capacity banks should have, and the present discussion is something in the order of 3% of assets, so a leverage ratio of debt to equity of about 30 to 1, actually a little bit more. Well, it's really not terribly difficult to imagine circumstances in which banks would lose more than 3% of the value of their assets, and if they do, effectively they're trading insolvent, and once an institution trades insolvent, it will do all sorts of crazy things, and creditors won't be willing to lend to it. So we're still very, very close to the margin of bankruptcy. The banks have been pretty successful in preserving what I think of as grossly inadequate capital support, and that I think is the single most important thing that has to change. Of course, there's tremendous worry about doing so, because it might slow growth and lending, and there's tremendous resistance from banks because it would lower their return on equity.
Do you think that those concerns, as expressed by the banks and as enumerated by you just now, are legitimate concerns, and they're right to be worried about those things?
Well, there's certainly a transitional question. How you would handle the transition is something we need to discuss. I think it can be handled perfectly satisfactorily by doing other things the banks don't like not allowing them to pay out dividends for quite a while. The fundamental problem we have, in fact, I'm just completing a book on this, is that we have got ourselves into what I think of as a Faustian bargain. We've made the core, or we've allowed the core financial institutions on which the entire market economy depends to operate with levels of leverage which are relatively new phenomena. That is to say, with such low levels of equity capital that they are fundamentally fragile. They just are so fragile that in any severe stress, they're going to get into a crisis situation. Now, I think we have to say, well, maybe that looks quite nice in the short run, but you can't run a market economy that way. It's fundamentally misguided. In a true market economy, when people expect to bear losses, the equity that banks would have would be probably almost an order of magnitude higher, certainly 3 or 4 times higher. And if we don't go there, then we're going to have crises like this quite regularly. So I understand the concerns, but basically we're just going to have to say, in my view, that we're going to have to make the transition. And I think we could make the transition without impossible problems. Once you start looking at the balance sheets of banks, you realize they do lots of things that aren't really essential for our economy, and they could shrink their balance sheets without it being the end of the world, and they certainly can raise equity, but it would be a big change in their business model. They won't like it. They probably won't be able to pay themselves as much, and my answer to that is, well, we can't live with these crises either.
In our last 30 seconds here, when you look at the financial and economic systems going forward, what's the one thing that concerns you the most?
Well, I suppose it is that we could have more crises, and in the meantime, we're not allocating credit terribly well. So we're going through these boom-bust cycles. In the booms, we lend very badly, we get into terrible difficulty, and the crashes are absolutely miserable. We've got to get out of this. That's the simple and overwhelming truth. We cannot live like this.
Mr. Wolf, it's always good of you to join us on our program here at TVO. And as I say, when you're in town next, if you want to come visit us again and do this in person, we'd love to have you here. Thanks so much for joining us.
It would be a great pleasure.
Martin Wolf, Chief Economics Commentator at the FT.
Support Ontario's public television. Donate at tvo.org.